Good afternoon, everybody. I've come across JP Morgan Asset Management's 7 Principles of Investing, and I thought let's just go through them because it makes sense to me. Right, number 1, plan for living a long time. That's a good one. You keep it in perspective that, we're living longer, probably have to work longer, and it's important to plan ahead. So I think that's a really good one. Number 2, cash is never king. I was always taught cash is king, cash is king. In a way, cash gives you optionality to time things, to invest when you need to invest. But generally speaking, holding cash, whether it's in a bank account or bonds, it doesn't really earn you much. Principle number 3, start early. Well, for those of us who don't start early, we don't have the option of starting early. But if you're a teenager or in your 20s, and you start investing early. Let's say, for example, you start investing $5,000 annually from age 25, and you do that until age 65, and you've reinvested your dividend income, etc. That $5,000 annually, by the time you're 65, becomes $640,000, which is pretty good. Which is pretty good for just doing a bit of passive investment. So starting early, I think, definitely is a good one. Resonates with a lot of people. Perhaps too late for me, but there you go. Returns, principle number 4, returns are correlated with risk. I think it makes sense, right? Higher risk you take, the higher returns you're likely to get. The lower risk you take, the lower returns you're likely to get. We generally sort of look at lower risk returns correlated with an overall index like the S&P 500, which are made up of blue chips like your FANGs. Let's start with those. Google and all these other companies, Microsoft, etc., and other companies too, of course. Returns and risk. Principle number 5, volatility. So markets are volatile. They go up and they go down and they go up and they go down. And the key thing is you've got to expect that. And you can't allow that to play with your emotions on a day-to-day basis. It's just part of life. But in general, over the longer term, things smooth out. There's a very, let's say, solid, clear trend line that's lasted for decades. And that is, markets generally grow. Stock markets between 5 and 9% per annum over the long term. So I think you can expect that kind of return. That's what I've read. Do your own research. Finally, timing the market. This is principle number 6 from JP Morgan. Timing the market is very difficult. On a daily basis, yes. But when you look at things on a seasonal basis, on a yearly basis, you can ascertain some trends where there are times of the year, or there are certain periods in the market where if you time it right and come in as a value investor, you can make a lot of money. So I'd like to qualify this particular principle from JP Morgan. Finally, principle number 7. Diversification works, and to a certain extent, yes. Diversify. Have a portfolio of X% of stocks, X% of bonds. It's shown to manage your risk and reward statistically. Fully agree. If you're a passive investor and you just want to invest in an index of S&P 500 companies, obviously there's diversification. There's lower risk of you making a specific mistake. But let me tell you, if we look at one of the greatest investors around, Warren Buffett, the majority of his investment portfolio is just in 5 companies. I think in total he has maybe 11, 12 companies, something like that. And his philosophy would be, well, if you need to diversify to that extent, it means you really don't understand the businesses that you're investing in. And if you admit that to yourself, then yeah, principle number 7 also holds. You should diversify. So that's a quick go through of JP Morgan Asset Management's 7 principles for investing. Just a quick recap. We'll come back to some more interesting stuff and more different types of investments in a later production. For now, Thanks for watching. Stay safe. Thank you.